Hey, what is up, dudes and dudettes? This is Dude-Diligence here. And today, due to popular requests, or just because I feels like it, let's react to meetkevin's video. And I haven't watched this video yet. I saw this video on my Discord, and two of my Discord members want me to react to this. And number two is a huge fan of meetkevin. I'm also a huge fan of meetkevin. We actually voted for him for the recall and everything. We think his whole thing about the transparency of the market is really, really important. And we honestly think he will be a really good politician, considering he will be like one of the first politicians who will basically vlog everywhere he goes and everything. And on the thumbnail, you will see the other guy. I think this is Bill Ackman, I think. Yeah, it's Bill Ackman. I think he's so keep in mind, so for those of you who don't know what meetkevin is basically a internet personality, someone who's, very good at real estate investment and who teaches personal finance. Bill Ackman is basically a hedge fund manager who short stuff, who go long on stuff, who make controversial statements on his Twitter account and all this kind of stuff. And also keep in mind that meetkevin is all about the transparency of the market. So I think he's gonna bash on Bill Ackman for certain things. And again, Bill Ackman and all of these hedge funds, their agendas are a little bit different from YouTubers. Therefore, there might be some intrinsic bias there. But I love meetkevin. I think he's a guy who's really good at marketing and really good at being very pithy, and he's appealing to a certain group of people who really finds his message really basically true to our heart. But also you gotta take it for a grain of salt, because he might also use this opportunity to push his own program. Let's see how this goes.
Folks, this ought to be illegal. This is absolutely freaking maddening. What you're about to see in this video is exactly how wealthy, rich, hedge funds, institutions, and suits screw all of us by turning us into their pawns and ripping us off out of millions to billions of dollars. This stuff ought to be investigated, and people like this should be in jail.
I absolutely love that intro. It just hooks you right away. It's like, oh, what is going on there? Oh my god, I'm making a commentary on this. I'm such a fanboy for meetkevin, and I love all the things he does.
Take a listen to this scenario here, folks. It's March of 2020, the start of the real pandemic in markets. We knew COVID was coming as of late January, but the real panic really started in March of 2020. And what you're about to listen to is a clip from March 18th. This date is really important. March 18th of 2020. All right, ready for this? We're going to listen to about 30 seconds of this. I'm going to jump to various different spots just so you have a little bit of an understanding of what Bill Ackman said on March 18th, what he was doing at the time, what he then did, and what he's got to say for us today. Let's get into this shady ridiculousness. You ready for this? Here we go. Let's put it on single speed because it's worth listening to in single speed. All right, here we go.
Now they'll want to bring in Bill Ackman on the phone. He took to Twitter today to urge the president to take more dramatic measures to stop the spread of the virus. Bill, I thank you for joining us today.
Thank you, Scott.
A number of ideas you put forth. I'm going to read one of them for our viewers to start. Mr. President, the only answer is to shut down the country for the next 30 days and close the borders, you say. Tell all Americans that you are putting us on an extended spring break at home with family, keeping only essential services open. The government pays wages until we reopen. I know from our conversations that you have been worried for some time. How did it manifest today with these tweets and going public?
Maybe just a little bit of context. I'm an optimist, but beginning in, late January, I was getting increasingly bearish.
All right, so I'm going to pause it here. Remember what was just said. The president needs to act more tough. The president needs to shut down, pay everyone's wages, bring the economy to a complete halt, shut everything down for 30 days to slow the spread. He's an optimist, but all of a sudden he's extremely bearish. Oh my gosh, everything's going terrible. In fact, things are going to be so bad, we're going to be in a new era. Listen to what the era sounds like we're going to be in. Here you go.
Period in the country rejected. We will call a vaccine is manufactured, distributed, and injected, we will go through a depression era period in the country.
Okay, so before he makes his next point, so it seems like we are getting too much of Kevin's perspective on the market and on Bill Ackman. So let me sort of put myself into Bill Ackman's shoes and explain to you why hedge funds don't short on January 2020 is because the hedge funds were a lot of funds around the world doesn't really think coronavirus is that big of a problem. And then for those of you who know me in real life, you know that I basically posted something in my, back then I'm still in school, right? Like a school website. And then I contact a bunch of people and telling them that I want to short the market because I see signals of market crash. And then everybody laughed at me. I went to family offices. I went to everywhere. Everybody laughed at me. Why? Because nobody was shorted the market when market is at all-time high. And then usually there's in every hedge fund and in every fund, there's sort of like a correction matrix. Only when correction happens, only when let's say Nasdaq or Dow Jones, whatever index fund that they use it as their benchmark indicator, they will only consider shorting it when it's under a certain percentage. And then what would do is Bill Ackman really likes to do from the previous years or from history is because one of the things that for my studies, we actually analyze different hedge fund managers and their investment style. And he's actually really prudent during market turnarounds or V-shaped recovery or market downturns and stuff. What he would do is he's trying to grasp the timing at where either FOMO is going through the roof or fear of basically not shorting is going through the roof, and then his short position only lasts on span from usually very, very short, less than a month. His short position doesn't really last that much, and then he usually doubled down on a lot of positions. And it's actually understandable if you don't start shorting on January and then around the March period. And we all know that one of the things that a lot of people in personal finance channel don't really talk about is in February we usually have oil reports, and then in March we usually have those for those of you who works in logistics, you will know that there are shipping reports coming out. There are other reports that some regular people won't have access to. And then for people who work in the shipping industry or in transportation, we have seasonality reports that will sort of give you an idea of where the market is going. And then this is why usually when you want to short the second quarter or you want to short by the end of the first quarter, what you would do is you would short in the beginning of March and exit your position by April, by the coming of April. And then because all financial institutions are on a quarterly to quarterly basis, therefore there are 4 quarters. So you will see them on, if the similar situation arises, they will start shorting in the middle of the March or beginning of March and get out of it in the middle of March or at the end of the March. And then their position will be reshuffled by April. Again, Kevin don't know about this because I'm assuming he haven't worked for a hedge fund before. The only reason I know about this because I live and breathe in this circle.
And millions of people will die around the globe, and
So, in other words, until we have a vaccine, we're going through a depression era period. Keep in mind, in March, we thought vaccines would take years to manufacture. Now, we're not going to debate about the efficacy of what we ended up getting in the short time frame that we...
Oh my god, it's so funny. Yes, the efficacy of all these vaccines. Guys, do you guys want me to post my initial DD on Moderna where I bought in at $20 and exited at $3.50, and then we bought back in, and then we exited at $4.50 and we bought back in, and we lose a little bit of money, but I ended up breaking even on the last small burst of a small proportion of the trade. If you go look at all the preliminary data and look at all of the data coming out, it's just ridiculous. Oh my god, I love meetkevin. He's so funny.
We're not going to debate that. We all know what happened to the market, but the point is, first, President shut down everything for 30 days. Bring the economy to zero. But keep in mind, we're going through a depression, not for the next 30 days. We're going through a depression for the next years until we get a vaccine, was his message in March. But wait, folks, what does he say about the hotels? Let's listen to what he says about the hotels and how low they're going. And what do you think the lowest is a stock price can go? Listen to this.
Hilton stock. We're a major shareholder of Hilton. Hilton is the canary in the coal mine. This is an incredibly well-capitalized, amazing, dominant global company that actually doesn't own many hotels. It just collects royalties, down from like 120 to 50. Okay, it's going to zero. Okay, along with every other hotel company in the world. Park hotels and resorts. Stock's down from 33 to 4.
It's going to zero. Listen to the CNBC anchor reiterate this.
This is a spin-off from Hilton. Why is it down from 33 to 4? Because every hotel is going to be shut down in the country. Everyone.
Oh, I distinctly remember this. This now remind me of this. After he had this talk, I started doing Hilton DD, and I realized that the bottom line revenue line is somewhere around like 47.5. And I was like, there is no bloody way that this thing is going to zero. Good job, Bill Ackman. Now you're inducing another big sell of the stock. And then I think I remembered I only bought 3 because I was being really prudent about position sizing. And later on, the reason I lost money in MMAT is because I wasn't being prudent, and it wasn't just being me, technically speaking, because number 2 was like, oh, it's fine, dude. Like, we were all like, a little bit impulsive in terms of like being young and everything, because I 6x my money during 2020, the downside, and then later on I bought back in again in September, and it goes up and up and up. And then like at that point where it's just like when we started and everything, it's just in 2020, like in September, and then 2021 is when me and number 2 started the YouTube channel in June, right? You guys know, like we haven't really started for that long, and then we sort of like started at the tail end of the bull market, technically speaking, and then we're like, our ego like are so inflated. He was mega profit. He's such a great like crypto trader. And he's like those people who are buying super early into new technologies, and if you guys want to hear us talk about why we don't think NFT is a good investment, comment down below, right? This video is going to be a little bit long, and it's just going to be like a heart to heart and all this kind of stuff. And he made so much money on crypto. He basically 2x his position in crypto in like in different crypto places, and then everything's going up. And then I was like on the high of buying call options. I was doing so great on trading AMC, trading other things. And then MMAT really stumped me because I was like, I think my ego really getting into the way. Anyways, we can talk about this a little bit more. But around this time of 2020, I actually bought in a lot of Halliburton. I bought a lot of Hiltons. I bought a lot of I actually started buying some like even a Carnival Cruise, and I started buying I started buying everything that's ridiculously undervalued. Like Halliburton was like bloody $5. Like really, like oils were negative, and I just bought like 2 months oil contract, and I was so happy about it. Anyways, it's just I think Hilton now is somewhere around. Let me see. I think I have a tab open. I was actually doing DD on some of those companies, hotel companies, because if you guys know, there's a company called Las Vegas Sands. Anyways, we're gonna post the DD video on that one, because there are some interesting hotel management and casino management in Macau is going on. That's why I'm doing DD on comparable resorts and all the companies. I think it's right here. You'll see it went back up to where 2019. And it went over a little bit, and like, how do you say this? Really dramatic at this point.
Hang on just 1 second. You say Hilton is going to zero? I mean,
no. Again, I'm a major shareholder. What I'm saying is, if we allow this to continue the way we allow it to continue, okay, every hotel company in the world, okay, is done. Okay,
Listen to this, okay? So wait a minute. We're at the start of a depression era that's going to last years, unless the president shuts us down for 30 days to slow the spread, and we bring our economy to zero, or our GDP to zero. But even if we do that, we still have to wait years for the vaccine, is the messaging he shares. And hotels are going to zero. Everything's going to zero. It's all going to zero. Okay? So what was happening at the same time Bill Ackman was on this call? Well, folks, Bill Ackman was actively shorting the market. He was substantially shorting the market. In fact, he took out $27 million in credit default swaps, far out of the money credit default swaps. And just 5 days later, on March 23rd, the market hits rock bottom. And guess what Bill Ackman does just 5 days later? Bill Ackman warned hell is coming because of virus. He then pocketed $2 billion in bets against the market. This article posted Wednesday, the 25th, 2 days after the bottom market, and 2 days after he closed his bearish bets and was able to cheer, hey guys, we did it. We opened up a bunch of shorts. We went on, told everybody about how hell is coming, how a depression era is coming that's going to last years, that hotels are going to zero, and unless the president shuts down the economy and brings it to zero for 30 days, we're all screwed, and even if he does, we're probably screwed anyway. Right after that, pockets $2 billion, 100xing his bet against the market after the fear he perpetuated, and this was widely circulated, and it all began with his tweets, okay? So folks, what's happening right now? What's this effer, this manipulating douchebag doing today? Take a look at this, folks. What kind of fear do we have today? We don't have coronavirus fears. We have fears over the Fed. And oh my gosh, if we tighten, the market's going to go to zero, right? If we tighten and the Federal Reserve raises rates, we're screwed. That's the fear we have right now.
Wait, first, I know Kevin doesn't really go into big data, but in our channel, on one of those videos that nobody watches, which have like only like 50 views, I talk about inflation doesn't have anything to do with where the equity market is going. So no matter how inflation works, it actually doesn't really matter for the equity market. So anything that you hear people saying that inflation will actually matters in terms of like short term or it doesn't matter long term, but because the inflation effect is so minuscule, it got baked into the pricing of the market instantly when inflation happens, and it sort of have a lasting momentum effect, but it doesn't have really a direct correlation towards that. I can actually prove to you guys. I've done the research, and in that video I showed you guys the graph of all of the statistical analysis of that. But one of the things that I don't know if he's gonna talk about this because first time I'm watching this too. I don't think he's gonna talk about how the perceived rate, why the perceived rate hikes is really that important, and then why maybe Bill Ackman or all of these hedge fund managers on their Twitter, you will see them. They're saying that. Of course, everybody's anticipating that rate hikes is going to be sooner than before, and they're anticipating a higher rate hike percentage on the first one, or they just say, the first and second will be fairly close, and then because we all know that it's going to be a 0.25%, which is 25 basis point increase, they're aiming for, all of these people are aiming for or spreading spreading the words of 0.5% should be the more efficient way of doing this, or 0.75%. The reason why they're saying this is because there's what we really need to think about here is, unlike other inflation cases, we have a very high spike of oil prices and consumption of oil. And at the same time, we have wage inflation, and the wage inflation itself is going through the roof because how the political environment really drives the economy to nuts here. So therefore, you have a compound effect here, and then therefore we're basically mimicking the market downturn of Y2K's effect. Therefore, we actually might see a bigger correction than we saw.
And the fear is because, oh my gosh, well, inflation is so bad, right? And if inflation is worsening, then the Federal Reserve is going to have to continue to tighten and raise rates, and that's it. Our economy is going to zero. We're screwed. We're done. It's over. Look at this, folks. While I am filming this video, here's someone on CNBC warning for big tech investors see 50% plus plunge. Oh my gosh, more sell-offs, right? But in the meantime, thank you so much to course member Mamal for sharing this chart here. This is what the market usually does when we have a rate hike and rate tightening cycle. Take a look at this. The average market response during a rate cut cycle is a return of about 23 to 32%. And during rate hike periods of time, we tend to see a return of somewhere between 54 to 102% returns on average. So in other words, the market actually outperforms during rate hike cycles compared to rate cut cycles, which is absolutely mind-blowing. But forget about that for a moment.
But the only problem here is on I think Kevin, I don't know if he's gonna talk about this. The reason why this happens is because we have this thing called dispersion. When dispersion happens, you will basically big money would basically like have an anchoring position to hedge on the S&P 500 when they think it already corrected, and then they will leverage up that position, and then they sort of and then they leverage that leverage position was puts on individual stocks, and what would they do it? They would ride the cycle along with it, and then the initial drop will be really high, but then the later upside cycle will be higher. Well, I will show you in here. So if you go look at Nasdaq, and if we look at the 1 year chart, well, obviously everything is going up, but when you see a dropping down over here, obviously like the timing of the data that you know Kevin gave you is a little bit let's just say a little bit biased in terms of how it was constructed, because if you look at how the rate high cycling are concerned, what really hurt in rate high cycles is only the first two hikes, and then extending to maybe the first hikes in the first year, and then later on it's just add up momentums with the first few hikes. And then as the economy as time goes on, the natural GDP growth and the natural growth and natural correction of inflation will eat up the loss that you initially accrued. But as someone who are a speculator, you will make the most amount of return within the time frame of when the first rate hike happens, extending towards the second rate hike.
Forget about that potential historical reality. Let's just look forward for a moment. What is Bill Ackman telling us? What is this hedgy suit telling us? Well, let's take a look, folks. Here we go. Bill Ackman, January 15th. While it has become conventional wisdom that the Federal Reserve will raise rates 3 to 4 times this year to mitigate inflation, the market expects a 25% basis point increment, 0.25% increase in rates. The unresolved elephant in the room is the loss of the Federal Reserve's perceived credibility as an inflation fighter, and whether 3 to 4 rates would therefore be enough. Rate hikes would therefore be enough. The Federal Reserve could work to restore its credibility with an initial 50 basis point move to shock and awe the market, which would demonstrate the Fed's resolve on inflation. The Fed is losing the inflation battle and is behind where it needs to be. With the painful economic consequences for the most vulnerable, a 50 basis point initial move would have the reflexive effect of reducing inflation expectations, which would moderate the need for more aggressive and economically painful steps in the future. Just a thought. Oh, don't mind me shorting the crap out of the market, basically and we don't know, we're just guessing that he's probably doing the same thing he did in 2020. But he's basically putting his thumb in a wound, going, yeah, you like that? You like that feeling of more pain? How about some more pain, huh? How about some more pain? While he's squeezing out cash out of the market, robbing you blind from behind, taking all the money out of your wallet. This guy, in my opinion, should be investigated. If he's shorting the market right now, he's a freaking fraud. Now, he's able to make money, but he's doing so stealing from people. And that is the scummiest form of capitalism that I believe exists in this world. But folks, what's actually happening with the market's inflation expectations? Because Bill Ackman is implying that inflation expectations are going through the roof. Well, wait a minute. Let's see what the bond market is doing. We know that treasury yields are going up, but there's actually a measure called the Treasury break-even rates, and this is when we subtract the Treasury yields on, let's say, a 10 or a 5-year from the 10 or 5-year Treasury inflation-protected security. So that way we can establish what does the market think inflation is likely going to be like, or what are market expectations for inflation. Even though Treasury yields are going up, take a look at what's happening to Treasury expectations, to inflation expectations. Folks, nothing. We are low.
Well, guys, so this you gotta take as a grain of salt, because Warren Buffett actually talked about long bonds and all of the bond market and the future of bond market and what he thinks the market would correct. And everybody deemed Warren Buffett as the very, very great investor, which I agree with them. I think it's one of, probably not the number one. And I actually have a different opinion on who's the number one investor in the entire world in terms of like the past 30 years or half a decade, half a century, that's a word. But in that Warren Buffett video, he talks about the reactionary. Basically, what he's implying is the reactionary reaction. The reaction of the bond market isn't as fast as how equity market would react to the rate hikes. Okay, and if you look at the previous bond yield graphs or whatever, you will see that those bond investors, they react in a very seasonal manner. And if you fit all of these graphs towards a mathematical algorithm, you will find that. If you guys want me to make that video, that also a side project of mine. What Bill Ackman was really trying to well, first he wanted to induce fear in the market, right? Because if you're short selling, the more other people sell, the more profit you make, which I think is totally unethical for him to do that. He needs to disclose whatever position he has when he sort of posts out all these tweets. As for example, he will say, I'm shorting blah, 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 or I hold major short position and I'm posting these, right? I think they need to disclose that, and I think it's extremely unethical for them to not doing that. But at the same time, he's right on the point, the 50 basis point, because, well, partially right on 50 basis point, because it's better for hedge funds to have a 50 basis point initial hike, because when they have the 50 basis point initial hikes, they can hedge the position really fairly well than the 25 basis point. I can go deep into that theory crafting or the mathematics behind that, because we did that for one of my projects that I need to deliver 2 weeks later, and we did a bunch of financial analysis on those kind of stuff. It's essentially when it's a 50 basis point, they can exit their position really well, but when it's 25 basis point, the incremental volatility after the first rate hike sometimes will destroy their position. Okay, this is why.
Lower than where we were in October and November in terms of inflation expectations. We are lower. We have had absolutely no spike here in January that has lasted beyond this little spike right here. We've had nothing that's lasted in 2022 so far, meaning the market is actually not pricing in more inflation expectations. The market's falling, quite frankly, because the market's falling.
Well, actually, the market is falling because all of the expectations are telling you that there's a correction. But when every expectation is telling you there's a correction, it's most likely the correction is going to rebound and then have an unexpected correction. And for those people who are interested in how, one of the biggest factors in inflation is actually oil prices. And we have a great, just fantastic oil expert in our Discord whose name is Bronco24, and you guys should follow him in his Twitter. And if you join our Discord, go tag him if you have any questions regarding the oil and everything. We are a channel that long on oil prices and long on commodity prices like natural gas positions, and we're doing pretty hot on one of those trust investment that thanks to Bronco's DD, and then I agree with a lot of the points that he makes. We have certain knowledge that most other part of the market doesn't have, because he's been doing this oil stuff for a long time. And I know a lot of people in my channel are older than I am. I'm really extremely grateful. And then we know that the reason why January inflation expectation doesn't really matter is because you actually don't have a lot of data on hand. A lot of those inflation commodity related data will come in late February, and a lot of those manufacturing data will be consolidated by the end of February in China. This is also the reason why hedge funds start to double down their shorting position on the beginning of March. And a lot of those shorting position we see right now, A is panic selling, B is they started putting up like call walls on top of the things to make sure that everything is stabilizes within acceptable volatility range. Anyways, if you guys want me to talk about the reasonings why hedge funds does what he does, or what they do as a part of the agents in a market, so then the market can function correctly or function the way that it was designed to, I will make a video about that.
And because hedge funds and institutions and suits are making money shorting the crap out of this market under the fear that all of a sudden the Fed hiking rates is such a bad thing and that inflation expectations are going through the roof, when that is not true. Inflation expectations are not going through the roof. The bond market is telling that to us loud and clear. Instead, it's scumbags like this trying to shake out the weak hands out of the market and rob people blind by putting pressure and pain where it don't belong, because they're scumbags who aren't transparent with their positions. And this is why I am 100% transparent with absolutely everything I do in my portfolio. If you join my Stocks and Psychology of Money program, you will learn.
All right, Kevin. We're not going to listen to you promote your program now. I absolutely love you. Number 2 actually is in a part of your program, so props to you. Love you too. Okay, you probably won't see my reaction to your video because, you know, I'm just a small YouTuber who doesn't really know what he's doing. And again, we're not financial advisors. We don't give financial advice. Everything we say on this channel is for shits and giggles. And even if I accidentally make any criticism towards you, Kevin, I don't mean it. And sometimes I can perceive as mean. But I'm just someone who likes to help and being really honest. And again, we're also really transparent of our positions in our Discord and our Patreon. And for those of you who want to support us to make more of those videos to educate you guys about the market, but maybe not in a perspective more of like the retail investor, but more on the side of the institutional investors, or more on the more institutional side, or giving you guys a different perspective on what you're hearing on the market. Comment down below, subscribe, like, and, you know, subscribe, join the Discord, and chat away. See you guys on the upside.